Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. Want to do a bit of an inquiry to where we currently stand with major central banks around the world, because it has been a whirlwind of reports with regards to changing of policy, changing of stances, upgrading of expectations, movements around sort of forward guides, all of the above has all come out in the last 10 to 12 days. I am going to take the Fed as read, and the reason for that, we've already gone through that quite extensively the week before, and it will get and be more important as we go towards the back end of the month. So I'm going to leave that to the side because we'll talk about that at another time. But I do need to quickly run through the ECB, the BOE and the RBA, because they all changed their stances quite significantly, some more than others, and some surprised by not doing anything in where they sit. Let's start with the ECB. Christine Lagarde has probably been the most dovish major central bank governor out there. She has resisted any form of suggestion that they're going to stop doing their quantitative easing program, resisted any idea that rates are going to move, and that realistically the Eurozone's got a real problem because COVID continues to absolutely rage through. That, however, has slightly changed. They didn't surprise by moving rates, and they didn't surprise at all with the statement. It was her press conference that raised a lot of heart rates with regards to how much she pushed back the idea that they will not raise rates in 2022. She couldn't say that categorically. Her line was that things have changed. And that's because if you look at what happened and what they're sort of talking about, the expectation in inflation across the Eurozone has rapidly changed in that space, and therefore they can't categorically rule it out anymore. They're also now moving away from their current stances with regards to where their programs are at. They didn't end them in saying that, but they are certainly now moving towards where everybody else is, which is that maybe the COVID stimulus programs have done their job, they're finished, and we need to start to move to another plan. That is not what was expected in the ECB, and that is not what they've been saying. It caused a big whipsaw going in the euro, and it's certainly going to play out more and more. The only thing about the ECB that annoys me is that there is a political element to it, and I think you need to be fully aware that Brussels and Frankfurt are quite interlinked at the moment with regards to how they do their materials, and therefore there is this underlying tone that there is a political edge to what's been decided and what's been done. So keep an eye on that as well. The BOE, well, that was a bit of a bang in terms of where we saw. Did raise rates. Second time they've done it in the post-COVID world. They're now at 0.5% on their bank rate. Moved up 25 bips, which was expected. There wasn't anything else to really harp about with regard to the changes in rates, but they did also say they're going to start letting their maturities run off. That's technically a form of quantitative tightening to some extent. So that is also the other part that's going on in the UK. That is starting to really ramp up their movements. What was also really eye-catching was the vote, 5-4, sounds very close, until you realise that the four that dissented were actually wanting 50 basis points rather than 25 basis points of rate rises. So the rate rise was an absolute lock and certainty. It's just whether or not it needed to be harder than what we got. That therefore locks into the idea that the mid-2023 view of 1.5% looks pretty assured. Now, they did try and push back on that with regards to their press conference afterwards, but the market looked through that. That's not what's going on. They are on a hiking journey, and they are as hawkish can be. Keep an eye on that, because also that plays out with the current scenario going on in the UK. They do have high inflation, but then you have seen really big increases in the consumer spending headline that are part of the essentials. Have a look at what's going to happen with regards to electricity and energy pricing in the UK. 50% jump in those over the next couple of months. There will be some big wrangling going on in the UK, and that is going to create some big headaches for consumers and also for their monetary policy, but again, also politically as well. Watch that space. It will play out in FX. Finally, the RBA. They did change a lot of things as expected, rapidly increased their outlook for GDP, massive increase in their expectation around inflation, and admitted that they had got it wrong and they're behind the eight ball. They also are finishing their quantitative easing program. The bond buying program will finish at the end of this month. But they resisted very strongly what the market is trying to say, that they're going to raise rates by up to 4 times by the end of the year. In fact, Philip Lowe went out of his way to pour cold water on that idea. They are now, as they say, data dependent, particularly around wages. And they want to see inflation sustainably inside 2 to 3%, not just getting into it like it just has, which therefore would suggest, because of where we stand on that, and he was open and conceded that rates may rise in 2022, that the RBA, if it is a live event, is November. That will be 3 quarters of GDP, 3 quarters of CPI, and 2 quarters with one to come in the wage price index. So it may actually mean that December is when it happens, not in November, because the wage price index will come out in mid-November this year. So the RBA is on the back foot with regard to that space, and they're happy to be there. And that also needs to be played out. They are happy to wait and see. They has very clearly pointed this out. Do not want to be following others just because that's what you're supposed to do. And that's the interesting thing about this. The divergence across them are there. And you saw that divergence therefore coming across in FX as well. Whipsaw, mixed movements and blah, blah, blah. So my point of view is this: find your baseline. And for me, the baseline remains the US dollar and remains the Fed. That therefore means that Constitution Avenue and what comes out of Constitution Avenue will be incredibly important to your positioning, and therefore US data comes with that as well. And that just gives you that base to understand where it's heading, so that whatever currency pair you choose, you've got an understanding about where the US dollar is and therefore the relation with the currency pair you're putting it to. So keep an eye on that, but it has been an incredible movement with the banking movements, and it will be for the rest of the year.